Hello, everyone. On today's edition of The Final Bar, we'll talk market pullback. We've had so much volatility yesterday. Nice up day finishing in a position of strength. Today, we have the opposite. We have more of a distribution, more distributive patterns, lots more sell-offs to pay attention to. But there are pockets of opportunity, and that's what we'll talk about in our Fishing for Alpha segment. Also, my guest, Javed Mirza from Canaccord Genuity. Ladies and gentlemen, this is The Final Bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller, the Chief Market Strategist here at StockCharts.com. I want to thank you for joining us every weekday after the close to think about today's price action from a technical perspective, try to connect the short term to the long term, understand how these fluctuations fit into the bigger picture. And no better time than a time like this week and the previous week when we've had more of a corrective pattern. It's always been said, don't confuse brains with the bull market. Another way is everyone's a genius in a bull market. When the market starts to sell off, when we start to move within an established range, that's when this gets kind of interesting. And that's when I would argue the charts can be incredibly valuable because it helps you understand where we're at relative to where we've been. So what we'll hope to do in this 30-minute segment together, think about today's movements, what sort of themes we can draw out, what today's sell-off means relative to the last couple weeks, and the long-term trends. And I think my guest, Javed, is going to do a good job for us, helping us understand the short-term versus the long-term on the S&P 500. We've got a lot of great content coming up on this show and on StockCharts TV. Coming up on Monday, our show Behind the Charts, which is more of a longer-form interview-style show. We're going to feature a recent conversation with Brian Shannon. He's the CMT and founder of Alpha Trends. Did a really good job talking about multiple time frames. Guests on this show coming up, we have Aaron Swenlin on March 11th and March 12th, our sector expert Julius DeKempner joining us. And then on March 17th, Tim Tashler. On March 18th, David Auerbach. David in particular is a REIT expert, so focus on real estate, which should be pretty timely given the strength in real estate in recent weeks. We also have the Traders Expo coming up this coming weekend in New York. If you are in the New York area and plan to get there, I hope you enjoy the show and hope you can get to our session. Unfortunately, we are stuck here in Seattle due to sort of the viral issues going on and plans for all of that. We will be doing my session via webcast, and it should be a really, really good discussion using live charts, talking about the mental state, the way you approach things from a mental perspective. So I hope you can join us for that as well, wherever you are. Let's think about the market activity as we recap the markets today, look at the movements and what they mean for the big picture. So we're going to start with just an update of today. The S&P finished lower, really gapped down out of the open, rallied a little bit sort of in the 11 o'clock hour, and then since then, really more distributive than anything. A bit of a rally going into the close, but that's coming off of a pretty depressed low. The S&P almost went down below 3,000 today, finished around 3024, which is down 3.33% or so. The small cap index, the mid cap index, down a little more. So it was led on the downside by mid caps, then small caps, and then the S&P down a little bit less, but all three of those down pretty significantly. That sell-off in the S&P and in the broad markets pushed the VIX, the volatility index, the fear index, almost back up to 40, so at 39.65. It's a pretty decent jump. So just like the market has increased volatility, the fear index, the fear gauge, the VIX, has fluctuated as well, and you're getting some pretty significant swings there. Let's look at a chart of the S&P 500 back and talk about some sector and group themes based on what's happened today. Refreshing the chart of the S&P, anytime someone asks me whether or not the 200-day moving average still makes sense with all the other inputs that we have, all the ways we can slice and dice price action, why would I still pay attention to the 200-day moving average? And I would say this week more than anything is one of the reasons why. If you look at the price relative to these 200-day, we have flipped above and below a number of times. I feel like every day we're either going above it or below it. Yesterday's rally back above the 200-day felt like a significant resolution to the upside, but we never went above the high from the previous day, and that was that dark cloud cover pattern that we talked about earlier in the week. So the idea is when you have a 2-bar candle pattern like that, the high of that 2-bar pattern, Steve Nissen told me years ago, is really the exit strategy. As long as we stay below there, that negative sign is still in place. So yesterday's close, not quite getting above there, to me suggested that it was still more negative than positive. And though today we have that follow through to the downside with the S&P going back below the 200-day moving average. Now, again, when we're looking at price relative to that long-term smoothing mechanism, it's all about the breakouts and breakdowns. It's all about how the price relates to those averages, but I think also it's a mental thing. It's a psychological thing. Excuse me. How do people interpret that break above or below the 200-day moving average? And there's always concern that if we break to new lows, or will we remain below there? And I think that's what we're looking for now. Is the sell-off today? Do we see follow through tomorrow? Do we get below 3,000, below today's low? That would sort of confirm certainly more distribution than accumulation. And most importantly on the S&P chart now is we've established a lower high. So before we had this big plunge lower, kind of rallied off. And the question is, all right, is this just some sort of a recovery period? Now we've really established a lower peak around 3130. And I think that's the peak level, the high level to be paying attention to. Going back to the member dashboard, let's look at some of the sector themes. So we had utilities down the least. Everything was down today, as you can see. Utilities down about 1.5%, followed by consumer staples. Real estate was number 3, followed by healthcare. At the bottom, you have industrials, financials, consumer discretionary. So some of the real, traditional offense down at the bottom, especially industrials and then financials. At the top, you have really defensive parts of the market: utilities, consumer staples, real estate. Those are the 3 sectors you'd expect to be at the top in more of a defensive market than an offensive market. That sort of pattern, and when we look in a little bit at the relative performance of utilities, actually, I think the 3 and 3 yesterday, one of those was the chart of the XLU, and that's why, right? You see this continued relative outperformance now breaking to a new 14-month relative high. That doesn't tend to be in a raging bull market that you would see that sort of pattern. Looking down at the bottom, let's look at the global ETFs. You had Hong Kong, EWH, the only global ETF in our little universe that we follow that was up. Pretty much everything was down today, but Chinese related ETFs, the A shares, also the others, all down the least today. At the bottom, you have the commodity oriented markets, Brazil, Russia. In terms of industries, not much to get too excited about. If you look, the gold miners and the mining groups, those are 2 very closely related groups within materials, both up over 2% today. And if you look at a chart of the gold mining group, we're going to look at that very quickly. You'll see, actually, I can just pop it right here. You'll see it's actually making new price highs. So at a time when most things in the market are sort of down, have sold off, and are still sort of floundering down at the lower end of the range for the last couple of weeks, gold miners have actually gone back up to the top of the range to new closing highs today. If you look at the relative line, look at how that had been really sort of a yawner for a while, for 6 months, and now has broken consistently to new relative highs, now outperforming the S&P about 35% over the last year. So it may be a time to revisit charts like Newmont Mining, like Kinross, like Royal Gold, RGLD, names that you probably have mentally pushed aside for so long because they've not been where the action is. Don't look now, but they've consistently been popping up to the top of the heap here. What pushed the market down the most? Well, to be honest with you, it's things related to the coronavirus challenges. For example, recreational services within consumer discretionary, airlines. You can see aerospace down here, REITs related to hotel and lodging, gambling, hotels. So these are the traditional sort of travel, luxury, retail oriented groups that you'd expect to struggle during this sort of environment. If you're looking at like the poster child of how the market is reacting to the coronavirus fears and the expectations of what could happen, looking at the transportation index probably isn't that bad of an idea. Again, because that includes things like airlines, it includes all the things that are probably going to get rocked the most from this sort of thing. The challenge here, as you can see, oversold, breaking to new lows, nearing a sort of an all-time low here for the last couple of years, the 2018 low. This is the market low. We're almost down back to those levels. Look at the relative strength, how it's continued to go down. So that transportation index, I think Dow theory, broadly speaking, has certainly rotated down more toward the negative side versus the positive side And this is one of the indexes I would be looking at just to follow sort of this negativity coming from all the transportation related names, including airlines for sure. That's our market recap for today. And again, I feel like with a quick segment, I always feel like there's so many stones left unturned. I would encourage you, as always, spend some time with scooter movers. Look for some of the stocks that have moved up and down. You'll find some hidden opportunities in there and things that may not have surfaced up for you in a while. Our next segment is called Fishing for Alpha. What we like to do is use the scanning engine on StockCharts.com, talk about some of the ways that you can scan for ideas regardless of the broader market activity. And what's cool about a scanning engine, this is more of a bottom-up process. What we've talked about so far is more of the top-down approach, right? What are the markets doing? What are the sectors doing? What sort of themes can we pick out? And then you look at names and groups within those sectors, within those themes, to try to identify potential opportunities. The other approach is more of a bottom-up approach. In two ways you can really do a bottom-up approach pretty thoughtfully. Number one is to use scans, right? So we're going to look at the scanning engine. I've got two scans that I created as just a way to think about some potential long ideas in this sort of environment. The second way is to do more of the manual process. Start from the first name in a long list and just go through a bunch of them individually. This is a process that I've done as part of my weekly routine. I usually do it over the weekend. I'll go through the entire S&P 500 every weekend with the goal of comparing patterns, identifying movements, and seeing which stocks relate to which, right? You'll see certain patterns in energy. You'll see certain patterns in other groups. Start to make some analysis about what things look when you roll things up from an individual stock basis. Today, though, excuse me, I'm going to look at two different screens. I have correction long ideas and correction long ideas RS using relative strength. Let's start with the first one. And again, if you're not familiar with our scanning engine, my boss, Chip Anderson, the founder of StockCharts.com, has recorded a couple episodes of his show, Deep Dive with Chip Anderson, where he goes through the scanning engine in much more detail. So if you're not familiar with some of the ways I'm constructing these scans, some of Chip's shows can help you understand them probably a little bit better and get more comfortable with them. What's great is it's all based on drop-down menus, so you can pick some of the items you want to do, add them to your screen, and then just customize some of the statistics related to them. This scan in particular is very simple. And again, I tend to use very simple scans because I don't want to make my results too narrow. I want to come up with a good workable list of stocks and then go through the charts individually to try to understand what message I can get out of them. Others like to make very particular scans. That's totally fine, but I'm hoping to share with you sort of how I think of scanning relative to the other parts of my process. So here we're looking at common stocks. I'm saying the close is above yesterday's 65-day max. So this is a common thing I look for, sort of a 13-week or 65-day high. So stocks that are going up recently. And I'm just refining it to the S&P 500, mainly just for the purposes of this show. So it's a list of names that we're probably familiar with, but in your own work, you're welcome to scan whatever that you would want to do, whatever universe. Here's the results of the scan. I usually sort these by sector just to see what sort of results I can come up with. We can see 8 stocks that are returned here. Half of those are within consumer staples. And as you can see, it's the type of things people would probably want to be hoarding in the case of some sort of broader disruption to society. And so it's things like cleaning supplies, soup, breakfast foods, and other things, Kroger for groceries. But you also see some healthcare in here. Newmont Mining, as I mentioned before, Rollins Inc., which is a name I actually wasn't familiar with, and I'll show you what these are at. So what we do then is store it in a new list. I'm just going to say, yep, keep it in that sort order. And let's look at the charts here. So Kroger's an interesting one. This is a stock I feel like a lot of people have loved to hate. Not too long. Going into the last week, right? Sort of testing the lows from last August. Coming out of an oversold condition, the relative strength had been weak. But like many things, completely turned course, and the beginning of this year has been relatively strong. The relative strength has essentially gone up consistently. It hasn't had a lot of negative moves from a relative basis, and it has this slow and steady sort of uptrend, reclaimed the peak from last November, and now this week has once again rotated to a position of strength, broken to new highs really for the last 10 months. So it's approaching the previous high, which is back here from April in the 43 handle, which is sort of the next objective I would be looking for on. I'm sorry, this is Rollins. Forgive me, I was looking at the wrong ticker on there. This is Rollins, but you can see the pattern that looks pretty effective there. Clorox is the next one. This is with non-durable home products, the relative strength has been fantastic, and you can see how the price has rallied really, really well. Again, going above the highs from last summer. That's a theme you're going to see with a lot of these names that are breaking to new price highs. Campbell Soup, same thing, has gapped higher in the last couple days. General Mills has not charted especially well. It's been flat on a price basis for a while, which is why the relative strength has been so negative. But look at how that stability has actually rallied very nicely on a relative basis. Sold off with everything else, but has recovered much better than most other stocks. And that's why the relative strength is back to the positive for the last year. Here's Kroger. This is now overbought. You can see the relative strength has really accelerated with a break to new highs. And then we're getting into some of the healthcare names. I do want to point out, for a stock like Rollins, if you're not super familiar with what some name like this does, no problem. So on our platform, you can now go to the symbol summary page. And if you go to the bottom here, this will actually explain what the company does. It's pest and termite control services. You can understand where they're located, what sort of business that they have. The second scan that I wanted to share with you is using relative strength. We're going to go to that next. Here we're saying just S&P 500 names that have outperformed the S&P over the last 10 days by at least 10%. So it's looking at relative strength instead of price strength. Now, arguably, you probably see some similar names in here, but now we have a much broader list to work at. Now we're seeing things like Electronic Arts. We're seeing things like Take-Two Interactive. These are in the video game space. Going down to the bottom, you'll see some other names within staples, but also something like CME Group that pops to the top here. So it's interesting to note, when you look at relative winners, it might be things that haven't quite broken out yet. This is really, really close looking at the chart of CME, but look at the relative strength has really improved. So over the last 2 weeks, as the market sold off, this has not broken down nearly as much, never really stayed below the 200-day, and now testing a new 12-month relative high. So I'd encourage you to look at that last screen if you haven't done it. And again, it's just looking at stocks that have outperformed it just during this corrective period. Look for stocks that have held up pretty well, and they might be names that wouldn't normally come out. You'll find which of the equity universe is more resilient than other parts. That's our segment, Fishing for Alpha. We need to take a quick commercial break. Be back with my guest, Javed Mirza from Canaccord Genuity. We'll see you in a minute. Hello, everyone. Welcome back to this edition of The Final Bar. Thanks for joining us every weekday after the close. And as always, please keep your questions, your feedback coming. Questions are best sent to us via email, thefinalbar@stockcharts.com. We read everything you send to us. Also, during the show, just put a quick comment in our Q&A panel. We'll probably have a mailbag segment tomorrow. We'd love to answer your questions. I can't imagine there aren't questions with all the stuff that's happening in the market, so please let us help you navigate these markets a little better using stock charts. Having said that, I want to bring on an external expert, someone who I've known for a number of years and have certainly followed his work. Javed Mirza from Canaccord Genuity, coming to us from Toronto. Javed, thanks for coming on the show.
Thanks so much for having me, Dave.
Absolutely. So everyone's sort of trying to get their head around the last week or two relative to the trends. You sent two charts. I hope to try to help us make sense of it. The first, a weekly chart of the S&P. What is this showing you?
So at the top panel, that's just price momentum MACD. So obviously we got a new weekly mechanical sell signal triggered on that sharp drop. So that's not great. However, what I would say and what I'm seeing on the other panels makes me extremely bullish here. So take a look at the second panel. That's just the ratio of the S&P 500 to the VIX. And notice that, especially with today's spike higher, we're at levels that we last saw during the January, February 2018 and the December 2018 trough levels. So I'm pretty bullish. And if you take a look at the volume on the bottom panel as well, so that's the puke out there. So to me, that says capitulation low, and a variety of the other indicators we look at as well, CBOE put-call ratio, investor sentiment, and then just a variety of other technical indicators. Everything to me has me pretty bold up here.
That's fantastic. So really suggesting a period of weakness that appears to be more of a bottoming pattern. How does the daily chart relate to what we just saw on the weekly chart of the S&P?
Yeah. So this is the chart. These charts that I've sent over. If you take a look at the date, it's February 28th, and so we sent out a note to clients, and then we were on our local equivalent to CNBC, which is BNN, just talking about how bullish we are, just because of the setup. So if you take a look at the second panel, that's just the McClellan Summation Index. So notice that we're at oversold extremes here too. So we were looking for a bounce this week, but one of the things, and I'm hoping we get to go through some live charts as well, is one of the things I talk about over the last couple of days is that volume has started to come off a bit. So I'm not too concerned here. Obviously, I'd like to see us close above the 200-day tomorrow, but we'll see how that plays out. But to me, this is all part of the longer-term bottoming process and our longer-term work. So, I mean, most technicians look at price, but we also look at time cycles, and our longer-term cycle work says we should have upside through into mid to late 2021. So I see this as an intermediate-term correction and a longer-term buying opportunity.
Interesting. So this is a great perspective, Javed, and I appreciate it. I'd love to ask two follow-up questions. Number one, if this is that short-term bottoming pattern or a bottoming pattern within sort of a longer-term uptrend, where would you be looking right now as an investor? Because you have a situation where things like utilities, real estate starting to outperform on a relative basis, even staples. It's not some of the traditional offense, things like industrials or maybe consumer discretionary. Where would you be looking right now, going out the next couple months?
Yeah, so I mean, we'll see how this plays out over the next couple of days, but I'd definitely be looking for some of the support levels I've highlighted here. So 29.54, you can see that's longer term support there, and then definitely the August lows around 28.41. I wouldn't want to see those broken, but what I'd be looking to do is pick away at some of the more cyclical areas of the market. So we just put out a note this morning highlighting copper stocks, highlighting in the U.S., so Freeport and Southern Copper, that's SCCO. So those to us look like they're trying to forge an intermediate-term price low. Some of the other industrial style names like Caterpillar. So all of these names to us look like they're trying to forge intermediate-term price lows. So there's definitely going to be a lot of choppiness and volatility over the next couple of weeks, because if you take especially a look at the chart you have on your screen right now, that's the daily chart of the S&P 500. Take a look back in August. So notice we had exactly right there. Notice we had a similar drop, obviously not in magnitude, but that was over the course of a week as well. But what we need, there's two elements to any movement in a financial instrument is price and time. So we've had the price move, but now we need to work through the time. So definitely, I think, like similar to what we saw as we ventured through August of last year, we're going to see some choppiness, some volatility. We're seeing 1,000-point moves every day in opposite directions in the Dow. So obviously, this is going to flummox a lot of investors, but we'd be focused on the longer-term charts here. And just the fact that I'd be using days like today to pick away at some names that I've been wanting to own for a longer time and that are on sale using discount code COV19.
Javed, those are two fantastic charts, and I love the parallel to last August because a lot of people that again, markets can correct in price or time or both. And you're right; it could just take some time to sort of figure this out. But overall, more constructive than destructive, it sounds like. Javed Mirza, thank you so much for joining us. Really appreciate your take today.
Thanks, Dave. Thanks for having me.
Folks, that was Javed Mirza from Canaccord Genuity coming to us from Toronto with two really compelling charts talking about sort of that bottoming process. And again, I would remind everyone, it's not just a bottom that tends to be made. It's a bottoming process. Takes some time, takes some movement, and some interesting charts reminding us about the long-term trends in the S&P. We need to wrap up the show, folks, going right to the 3 in 3. So at the end of every show, we do 3 charts in 3 minutes. And if these are not on your radar yet, I hope they are from this moment on. Chart number 1 is looking at the S&P 500 at the top. Long-term chart, we're going back the last 5 years or so, but at the bottom, we have the new highs and new lows on the NYSE and the new highs and new lows on the S&P 500. And the reason why I want to show this chart is, I found a lot of times, a lot of my charts, I'm looking at the last year. And if you leave your charts just like that, the last week or two is going to feel completely different than anything we've seen because the environment has certainly changed, right? I mean, it's a different level of volatility. It's much more of a sudden sell-off than we've seen in quite a while. So looking at a longer-term chart can help you put this pullback into, I think, a proper longer-term perspective. Try to understand how this relates to some of the other sell-offs. And the reason why I wanted to point this off is at the weakest part, when we sold off the most, this was on the big down day last week, at the most, we had 100 S&P stocks going to new lows, 52-week lows. So about 1 in 5, right? 20% of the index, which seems like a lot to me. And it is if you look at the last couple months or year or so. But if you look back, excuse me, at the market low, end of 2018, this actually went dramatically lower. We got down to almost half of the S&P breaking to a new 52-week low at the same time. At the 2015 cyclical bear market, 2015 into 16 over on the left side of the chart, you can see we got well below 100 here in August of 2015. Again, at the beginning, first quarter of 2016, which ended up being the short-term, sort of longer-term market bottom before the rally into 17 and 18. So my indication here, my illustration is just because we've sold off a lot, it was very sudden, but again, not as many stocks sold off as we saw at some of those previous really long-term lows. So it'll be interesting to see if we do start to retest those lows, does this increase to the downside? It might tell us it's more of a negative pattern, but we are down below some of those previous short-term pullback levels for sure. Chart number 2 is looking at the AAII ratings. This is the American Association of Individual Investors, every week polled on bullishness or bearishness on the equity markets or neutral. And this week, what happened? So we had the sell-off last week. We got a lot more bears and an increase, a huge swing from bullishness to bearishness. Now we're right back to flat. So an increasing number of bulls went from about 30% up to 39%, but an almost identical number of bears. So the bearishness is still there. I think some of the neutrals may be upgraded into bullish, but it's dead even essentially between bullish and bearish, which is certainly how the market feels right now, more indecision than direction. The final chart is a very long-term chart of the S&P 500. This is looking at the S&P back to 1926. And I'm doing this just to illustrate that this sell-off, which feels incredibly negative, is this little tiny blip here on the far right corner of the chart. And remember, it actually looks totally reasonable. It looks within perfect context of the last 10 years of the cyclical uptrend or secular uptrend in stocks off of the market low in 2019. Also, you'll notice the RSI on the monthly chart never really got below 50. You can see when it remains sort of above 40 for sure. That's more of the secular bull market phase. When it gets below 40, that tells you we're starting to get into more of a secular bear market phase. And we saw that in the 1970s, also saw it in the early 2000s, which indicated this change in regime. So overall, again, while this feels sudden and severe in the short term, and it is, relative to the long-term picture, it's still within a solid uptrend, which again goes back to what Javed was telling us earlier, looking at the weekly chart of the S&P and then looking at the short term as well. So overall, trend remains positive, but in the short term, certainly it's all about measuring the signs of where we're at relative to where we've been. And ladies and gentlemen, that's our show for today, a Thursday afternoon here in Redmond, Washington. I want to thank you for joining us every weekday on the show. We are doing a lot of adjustments due to some of the coronavirus issues here in Western Washington. So thanks for being patient as we figure out how to keep these shows going for you as best as possible. Ladies and gentlemen, for StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.